Big shout out to Prime XBT for sponsoring today's video. If you don't know who Prime are a platform where you can not only trade crypto, but you can also trade FX, commodities, and stock indices. And the beauty of these guys is you can use crypto, either Bitcoin or USDT, as collateral to trade against these pairs. If you want to find out more about them, then check out the links down in the description. And if you do want to trade with them, then use our codes below to get up to a 7,000 USDT deposit bonus and 25% off trading fees. So thanks once again for sponsoring today's video. Good morning, gang. Good evening. Good night. Wherever you are in the world. Welcome back to our second episode in our new educational series. Obviously, if you didn't catch last week's, then go check out the video. There's a playlist created on our YouTube, and you can go back and watch basically how to calculate your position size and also risk management. Now, this episode is going to be covering, as you can see on the screen, fundamentals versus technical analysis, because this is something that I get asked quite a lot in the group, especially in the free group, ones that don't know us. And that's why I don't trade fundamentals. And what I want to do is I want to run through. Now, this video is probably going to go down like a lead balloon because there's a lot of people out there that really believe in fundamentals, and that's absolutely fine. I want to start by saying that I do believe fundamentals can have a place when it comes to trading. You get fundamental traders and you get technical analysis / price action traders. Both are fine. But I want to talk through some of the flaws with the fundamentals, and especially when it comes to the crypto world, and then I want to then bring it on to why TA is better. And this is just my opinion. Obviously everything discussed today is not financial advice, not a financial advisor. This is just for educational purposes only. But let's begin. So let's first and foremost, let's have a look at fundamentals. So obviously, what am I talking about when we're talking about fundamentals? And this is more specifically aimed at crypto, but it can be spread to stocks and traditional land. But effectively, when people are looking at fundamentals in crypto, especially on let's say an altcoin, people are looking at the team. Who are the devs behind it? They're looking at the tokenomics. They're looking at the community. They're looking at the project. What does it fix? What does this crypto do? And then influencers, who's on board. Now, obviously, you guys know my view on not all of the influencers, but the majority of influencers. You guys know my view on that already. But anyway, so that's what people are looking at ultimately when they're looking at fundamentals of an altcoin, and they use this data here to try work out whether a project's worth putting money into and if it's going to make them rich. And that's simple of it, because at the end of the day, most people come into crypto, come into altcoins, and they watch a few YouTube channels and they think, right, I'm going to get rich. This coin is going to 100x. And that's what people lead you to believe. Now, the reality of it is, this is what you're looking into when you're looking into these topics. The team, is it trustworthy? Are some of the devs involved in previous bad projects? There might be, there might not be. There might be complete unknowns. There might be anonymous. More of a red flag. The tokenomics, obviously, we're talking about how the tokens split. By tokens, what I'm referring to is the actual coins themselves. How many go to the community, how many go to the team. It's a very valid thing to look at, in my opinion, is this. It's not something, again, I personally don't look at because I couldn't care less. But, when fundamental traders are looking at this, it's very, very valid. The community. Now, I've put here liquidity, and this is what's probably going to go against me in this video. And that's absolutely fine. But at the end of the day, the bigger the community, the more people believing in the project that it's going to moon and it's going to 1000x, then realistically there's more liquidity there for someone that's smart to get out with a trade and exit with a decent profit and leave people at the top bag holding until it reaches new all-time lows. Okay, the project itself, again, does it actually solve anything? A lot of crypto projects out there don't actually solve anything. They're not fixing anything. They might be fixing something between its own chain that it's created on, and that's absolutely fine. But is it fixing a real life thing? Has it got a real life use outside of a little crypto community, let's say? And then again, coming onto the influencers, right? These are the people that are paid to promote a project. So you'll see some influencers, on Twitter, on YouTube, and they'll be telling you about the next coin that's going to 100x, and they're not doing it off anything apart from either A, looking at these details and making their own opinion of it. But you've also got to ask yourself, why are they talking about that project? Because they've already got a bag, perhaps? Or is it because they're getting paid by the team to promote the project? This happens, right? And you can disagree with me all you want. This is how pretty much all tokens start life. I can show you my Twitter inbox quite happily and show you how many messages a small account like ours gets every single day asking us if we'd be interested in a paid partnership to promote their new altcoin or their new NFT project, because that's the only way they get the marketing out. Now, marketing's not necessarily a bad thing, but when certain influencers use it the wrong way, they will put out their video to their hundreds of thousands of viewers, or they will tweet to their hundreds of thousands of audience. They know full well that people are going to follow blindly and buy said coins, which at that point, that's when they unload them. They get out of the project, then they don't care about it anymore. That's fine. They may have a contract from the team that says you need to do X amount of tweets a week or X amount of tweets within a month, and then that's it, their deal's done. So as long as they've done that and they've got rid of their coins that they've been given by the team, then it's then free to run by itself, and it's whether that token then gets picked up by an exchange or not. And effectively, that's how it works, and that's just real life. That's that's crypto in general. That's how it works. Right. Okay, so what do fundamentals not show us? Right. Well, the thing with fundamentals is they don't give us an entry. They don't give us an invalidation. They don't give us a take profit level. And without any of this, we can't work out our risk management. Again, if you want to know what risk management is, go check out our previous video that we did last Sunday. We talk about risk management and position sizing in that, which involves all this criteria. Now, why do I have a bee in my bonnet about this? Well, quite frankly, people get overexcited with fundamentals. Strong team, strong community. If you've got a community of, a few hundred or a few thousand people in a community, they're all telling you to hodl, 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 hodl. And that's the word that gets banded around. And that's fine. However, it leads to a herd mentality. So therefore everyone holds, I'm not going to sell because he's not selling. I'm not selling because she's not selling. And then people hold on. And then the smart traders that are looking at price action are getting out of the project and selling, and these people are still holding. And then they're left holding all the way down till the project either A, rugs, or B, comes to a new low, like a bear market like we are currently in. Okay? So even if you trade from fundamentals, which again, I'm not saying you shouldn't do it. I'm just saying I personally don't do it for these reasons, and this is my reasoning behind it. So even if you trade from fundamentals, I still firmly believe that you need to understand how to trade or how to spot signs of toppy markets, or when it's a good time to get out. Key support, resistance levels. Now, obviously, if you guys want to go into like real detail on this, then come check out our website. Links down in the description below. And on here, you can either get access to our free Discord, where we've got well over 1,000 members now, each with different forms of TA, sharing ideas, hints and tips, all in the free group. And then obviously, if you want to learn to trade like I do, and what I teach are rapidly growing number of co-pilots, then come check out our course. For under £60, you get access to a heck of a lot of content. It's a bit of a snapshot of it all. Everything from absolute beginners through Fibonacci, volume profile, patterns. Now, patterns are obviously very popular, but I don't trade patterns the same way other people's do. Order flow, Elliott wave theory, psychology, managing trades, entering trades. There's so much content on here. And then we do weekly live streams. We go live on news events. And I also post every single day my trading plans for Bitcoin and also some altcoins as well, and also stocks and Forex. So yeah, if you guys want to get involved and learn how to trade properly and how to trade using TA, then check out our website. But anyway, let's come back to this. So this is why I believe, you need to learn the basics. So what are the basics? Well, let's talk about spotting potential tops of markets. So obviously we're looking at Bitcoin here. Great example, because this is what I trade day in, day out. And let's talk about when we opened our Twitter account. So we actually opened our Twitter account around February 21. And the reason why we opened our Twitter account then is because a few friends were asking us to do so. And because we believed that we were coming up to the top of the cycle. And the reason why we believed that we were coming up to the top of the cycle, and again, this is where, if everyone remembers back here, there was Sailor buying, there was Elon Musk buying, 100k, everyone on Twitter changed to laser eyes, and the market was starting to get a little bit euphoric. So that's one warning. When projects and teams start to get a little bit euphoric and start throwing out random numbers, and by random numbers I mean, your best random number what was thrown out for Bitcoin was 100k. Now why 100k? Because it's a round number and it's a big number, and then people buy into this, but there was no technical reason why Bitcoin would have got to 100k this time round. There is a technical reason why Bitcoin got to 69k this time round, because that is a level that's historic right back from the inception of crypto. And if you guys are in our Discord, you will know why this was a very key level. But let's have a look. So we're looking on the daily chart here, right? So how do we know, or how can we make an educated guess that a market is topping out? Well, one thing you can understand is a thing that we call harmonics. So this is the thing then that we were posting this. This was, if you go back to February on our Twitter account, February of 21, you will see us posting this several times, in fact, warning people. Now bear in mind we had a very small account back then, that we had the 3 drives pattern. So this is a harmonic pattern. It's called the 3 drives pattern. Now this is some, I'm not going to go into depth on how to use this, but this is a pattern that I teach in the group, because it's a very, very, very powerful pattern, because it's used for spotting market tops. Now whether that is a full-on cycle top like this, or whether it's a low time frame, either way the 3 drives comes in handy. It can also spot lows as well, right? But what we can see is we've got a drive up, then a pullback. So we are making a higher high, a higher low, a higher high, a higher low, and a higher high. So in trending terms, this is still an uptrend. We can see high, low, higher high, higher low, higher high. Obviously this is looking on the daily chart. Obviously we flick it to the 3-day chart, we flick it to the weekly chart, it all looks the same. High time frame, uptrend. Now once you start to see something like this 3 drives pattern, then you can start to make an educated decision then, thinking, well, a 3 drives pattern is typically an ending pattern and a reversal pattern. So what normally happens, you get your first pullback, and as we can see here, let's just remove this tool for now. We can see this. We've got our first pullback. Now this pullback takes out this swing low, which is this one on our 3 drives. Right, so now we can start thinking, well, have we broken structure now? Because obviously we no longer have high high, high low, high high. We've now got a new low which has taken out the last lower high. So we can start to think, well, is this starting to break structure now? And lo and behold, it did break structure, because what happened was price came back up, struggled to get past this golden pocket here, and then continued to pull down. So this is a typical play for a 3 drives pattern. You will see the 3 drives pattern come into play. You'll see the first thrust down, which ideally you want to see it to break structure, and then come back up and then continue with that structure break. And obviously at this point here we broke structure of this, so then we confirmed this as a lower high, and then we're looking for a lower low to take out this. So this, on a daily time frame, we are starting to change structure to a bearish structure. Okay, so therefore this for me if I was trading fundamentals and I was holding on, and let's just assume that Bitcoin is one of these altcoins, or even more Bitcoin itself, having an idea of what Bitcoin doing when you're trading altcoins is probably what would give you the biggest edge over everyone else that's also holding that same coin. And that's something that you need to know. So once you start seeing this on high time frame, you can see, right, well, it's time now. You've seen this. Maybe I should start taking some profits. So let's say that you're holding a bag from down here. Say you got in the project dead early. And so this is the inception of the project. You got in dead early. And you've ridden this up. And obviously greed's taking over. Everyone's telling you to hodl. You've got laser eyes going on. Everyone's saying it's going to go to the moon. It's going to go to 100k. You know, the project itself is already up 500%. You know, that in any investment term is significant. That is very significant. Okay? That's big. That's overextended. So you start to see this and you start to think, all right, well, maybe it's time to get out. What else could I be looking for that will confirm this? Well, let's use a really basic indicator. Right, let's look at the RSI. So let's change this back to, let's look at the 3-day and we can see this a bit clearer. So we've got the 3-day. Now what can we see here? Well, we've got this drive up here, which is the highest point on the RSI. The next drive up creates a lower high, and yet we've got a higher high on price. So we've got a lower high on RSI, higher high on price. This is a divergence. So this is one leg of divergence. Okay, there's your first leg. Then we'll come down and we drive up again. We get another high high on price. Once again, we get a lower high on RSI. We've got another drive of divergence. Okay, one drive, two drive. We'll come back down. We'll come back up. High high on price. Another lower high on the RSI. That's 3 drives of bearish divergence. 3 drives, so this is powerful. At high time frame, 3 drives. 1, 2, 3. Each one of these, 1, 2, 3. Now you're starting to think to yourself, okay, well, we've seen the 3 drives pattern. We've seen 3 drives on a high time frame. This is on a 3-day. Right, it's 3 days. It's a high time frame. We've started to see this. Now you've got to start thinking to yourself, let's get the hell out of the market. Yes, there is a chance this could have been a pullback and this could have continued. There is a chance. But let's look at it from a technical point of view. Any technical analyst out there, any true trader that is not trading from fundamentals, that's trading from price action, is going to be saying right now, if not here, then certainly here, get the hell out of the market. Okay, but the problem with this, and like we saw at the time, is in this whole zone here, as much as we were shorting this, and I was selling every single one of my Bitcoin at the time, getting out of the market, you still get the people on Twitter with the laser eyes, you still get the people in the community groups saying, hodl, 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 this is just a pullback, it's going to go up, because they've experienced this. They've experienced this parabolic uptrend. So therefore, this is where fundamentals falls down. Because fundamentally, everything's bullish. The team's bullish, the community's bullish, you know, the project's running well, whatever it's doing, everything's bullish. And people are saying hodl, 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 hodl. But what price action is telling us is potentially get out the market, we're in for a reversal. What happened? We get a reversal. Now in the case for Bitcoin here, you did actually have a second opportunity to get out of the market. So if you missed this, absolutely fine, don't get me wrong. How you'd miss something like this on such a common indicator, and I don't even trade with the RSI. I personally don't use it, but this is what a lot of people do use. But the problem is they use it wrong. A lot of people use it wrong. You know, a great example is RSI doesn't take into account wicks. RSI is actually based on candle closures. It's actually based on bodies. It's not based on wicks, it's based on bodies. And you don't want to go too far back either when you're looking. Okay? But with this example, if you didn't get out here, fair enough, you know, you missed an opportunity there. But luckily, like with Bitcoin as the example, is you got another opportunity. Now let's move this over to the weekly. So we're going for an even higher time frame now. So let's see this now. So obviously we came down, and obviously it was a decent correction. Then we came back up, and then we created a new high. Now again, on closures, we created a new high, but RSI created a lower high. So now we're starting to think, well, we've got some bearish divergences here as well. So this could, at this point, and I agree with this could have continued up. It could have continued up because this can be invalidated, just like what we saw over the last couple of days on the lower time frames. There was potential for bearish divergences happening, but all price did was just continue up. So therefore it invalidated the lower time frame bearish divergences. Okay, so this could have continued up, but we can see this now on the weekly. So we're on the weekly and we've got some bearish divergence. And then let's zoom back down to the daily. Now this is purely going from price action. Purely going from price action. So let's turn off the RSI. Purely on price action, we can see. So obviously we've got this uptrend. High highs, high lows. High, higher low, higher high. And then at this point, we can see we come back down and we take out this. So once again, we can start to see now that we've broken structure. On the daily, again, on the daily this is, high time frame, we've broken structure. So we break structure at this point. And then we go low, lower high, lower low, lower high, lower low. So we are downtrending. At this point, if you didn't manage to get out over here and you held a little bit longer, maybe you locked in some extra profits, but you've now got another warning now. The high time frame is making a trend change to the downside. This high here did not take out any of these. So therefore, that's a warning sign. And again, this comes down to technical analysis and this comes down to price action. It's a warning sign. Potentially start to get out of the market. Sell your bags. Then price drops. Okay? So this is why I prefer technical analysis over fundamentals any day. Again, like I said at the beginning, people that do trade with fundamentals, absolutely fine. You know, people do earn a living from trading from fundamentals. That's absolutely fine. But the problem with just trading from fundamentals is without knowing the basics of technical analysis, and there's a lot more detail to go through on this, by the way, without knowing some basics of technical analysis, you don't know when to get out of your bags. And you will likely let greed and FOMO take over, and led by the herd mentality within a community of price is not going to stop. Especially if this was your first bull market. Just like people did back in 2017. A lot of people's first bull market, and then they weren't prepared for this. Okay? So, learn the basics of TA. Even if you still want to remain a fundamental trader, absolutely fine, but at least do your future self a favour and learn some basic technical analysis so you can understand when's potentially a good time to get out of the market. How do I know if something looks overextended? Is the divergences happening? Okay? Right, that'll do for today's rant. If you guys want me to continue this series, then make sure to let me know down in the comments below. Make sure you drop a like and subscribe and tick that bell notification so you don't miss our future videos. And until next time, gang, that'll do. Bye-bye.